Welcome back, friends, to the second episode of the Meb Faber Show video channel. If this is your first episode, hit pause, go back and watch episode 1, because in that episode we set the base case for all future episodes, which is all about expectations. So in the first episode, we took a gaze backwards in time. What did history mean for investing returns, the path they took to get there? In this episode, we're going to turn our gaze to the future. Can we expect similar returns that markets have given us in the past into the future? So we're going to start again with the beginning where we started last time, which was most people expect 10% returns per year. You probably wrote that down on the first episode. Is that realistic? Well, good news, everybody. We can go back to the 1990s when John Bogle, the founder of multi-trillion-dollar Vanguard, one of the fathers of index fund investing, wrote a paper where he talked about a very simple formula. The formula only has 3 parts, and this stock return formula gives a very good indication of forecasting expectations of how stocks should perform over the next decade. So future returns per year equals, and there's 3 variables: starting dividend yield, dividend growth, and lastly, change in valuation. That's it. So if we look back in history, and we'll round up, use that 10% number, you can show average dividend yield was about 4.8%. Gone are those days, but we'll come back to that. So you have a 4.8% dividend yield. You have about the same in dividend growth, 4.9%. And then over the course of the past century and a half, you've had a little bump from valuation multiples increasing of about 0.3% per year. Add those 3 numbers, you get 10% returns. So here we are in April 2019. We can plug in the numbers of today. Where does dividend yield sit? Unfortunately, it's down around 2%. We'll assume similar earnings and dividends growth as has happened in the past. It's traditionally a hard variable to forecast. It oscillates, tends to mean revert over time. So we'll assume 4.9%. And we'll also assume no change in valuation. Well, already, just because of the dividend yield, that takes you from 10% down to around 7%. And very quickly, nerd alert for the guys out there that are quants like me, you can actually explode the dividend growth equation into real dividend growth and inflation. Now, because of stock buybacks, that has the effect of dividend growth being higher than in the past, but also we have lower inflation in the past, so they somewhat cancel out. So we'll ignore that for now. But let's talk about the last variable, valuation. So if you think about valuation, this is a variable we can go back 100 years. People have been talking about valuing stocks and stock markets for as long as people have been invested in markets. Let's go to the father of value investing, Ben Graham, professor at Columbia, Warren Buffett's mentor. He used to talk about a valuation metric called the price to earnings ratio. Very simple, price of a security divided by its earnings. But what he did is he would average it out over 5 to 7 years. That way you can try to find the signal from the noise to smooth out the effects of expansions as well as contractions and be able to find a signal for security. Is it cheap or is it expensive? Many years later, Professor Shiller, now a Nobel laureate at Yale, wrote a paper talking about let's apply that simple price to earnings metric to the entire stock market. And let's use a 10-year time frame, really long term, to be able to have an estimate, is the stock market cheap? Is it expensive? So he took this valuation data all the way back to the 1880s. And what he found for US stocks shouldn't be surprising. At times the market's been really expensive, think the roaring 20s, and other times, the Great Depression, the early 80s, it was really cheap. So the average value over time of what Shiller called this cyclically adjusted price to earnings ratio, we'll call the CAPE ratio, but again, it's nothing more than the 10-year price to earnings ratio adjusted for inflation. The average over time has been about 17. When inflation is tame, like now, the average has been around 21. But at times, think about the roaring 20s, it's been as high as 30. Great Depression has been as low as 5. My favorite bubble, the internet bubble, it hit a price to earnings ratio of 45. Crashed afterwards. The run up to the financial crisis crashed again, got to the low teens. Cheap. How many of you guys were buying stocks in March of 2009? Not many. The world was ending. Lehman Brothers was going out of business. and then it's run back up to a value of around 30. So what does that mean? A lot of people talk to me and they say, Meb, the CAPE ratio no longer is useful. And I've heard this 1,000 times. Let's talk about valuation. Look, people, it is a blunt tool. It is not going to tell you what stock's going to do next month. It's not going to tell you what stock's going to do next year. But what it does do is it gives you a good guide. Almost any valuation indicator you use, and CAPE is a great one. It's one of my favorites. But when a market is expensive, so the US is a value around 30, 31 right now, on the expensive side of history, every valuation indicator should say the same thing. You can't find me a valuation indicator that says US stocks are cheap right now. And on the flip side, back when the CAPE ratio was 5, you couldn't find a valuation indicator that would say stocks are expensive. So blunt tools, the people that are trying to forecast US stocks out to the third decimal place, not what this is for. In general, you want to use it as a guide. Historically, and we outline this in our book, Global Value, again, free to download online. Go to CambryInvestments.com. You can download a whole bunch of our books. If you use value as a starting point, when the CAPE ratio was really cheap, at a value less than 10, US stocks had great returns. And then you can just picture a ladder going down for each increase in price. When it gets up to 15, then 20, then above 25, future returns were lower. Doesn't mean they were negative or even bad, it just means the returns were lower. You can compare this to something like housing. It's not rocket science. Baseball cards, cars, anything. The more you pay for something, the lower your future returns will be, and the less you pay for something, you probably have a margin of safety. Think about stocks as an infinite time horizon claim on future cash flows. So when you're thinking of things that are 20, 30, 40 years out, which is what stocks are, the valuation in the short term matters. So as you look back over history, stocks are super volatile like we talked about in the first episode. Let's look at the 3 best starting points in history. If you were lucky, won the lottery, were born at a certain time, started investing for the next 10 years, 3 best starting points in history, you made 20% per year. You get rich quick at 20% returns per year. But let's look at the characteristics of the starting point. Historically, the average dividend yield when you invest in those periods was 5%. Awesome, gone are those days. The CAPE ratio valuation at the beginning of those periods was 11. And at the end of the decade, it had increased to 25, meaning you had a valuation multiple expansion over that period that gave you tailwinds of 9% returns per year. And if you look at the 3 worst starting periods, sorry, unlucky, you got 0 returns over the next decade. Again, not negative, not terrible, but on average around 0. Dividend yield was lower, around 3%. Starting CAPE ratio was 28. And it ended that decade at 13, so got cut in half. People went from wanting to pay a lot for stocks to not wanting to pay a lot. That caused a valuation headwind of 7% per year. And if you start to plug in the values from today, where does it look like US stocks are currently? More at the beginning of a secular bull market or bear market? I'm a quant. I love to tell people the way you have to think about investing. It is an uncertain future, and there's a spectrum of probabilities and possibilities. That does not get you invited back on CNBC. People want to hear with full certainty, the market's expensive, it's going to crash. Or this is a generational buying opportunity, you have to be buying stocks, pound the table. But in reality, that's not the way investing works. So let me give you an example. I like to think about investing as, say, going to Vegas and playing blackjack. You're sitting at the table, you get dealt a 16, the dealer's got a 10, chances are you're going to lose that hand. It's not guaranteed. You may get a 5, dealer bust, 21, congratulations, you won. And on the flip side, if you get dealt 2 10s, dealer's got a 6, you got about a 70% chance of winning that. But just like the guy sitting at the end of the table that's harassing you before he goes back and plays slots and loses all of his money, you're not guaranteed the outcome. So we often say the future is a spectrum of possibilities. How do we apply this blackjack analogy to the markets? So if we go back to our old Bogle equation, we can plug in the variables. So we know what the dividend yield is right now, 2%. We're going to assume the same earnings growth. Look, we don't know. Elon Musk may find free energy on Mars. There may be a huge worldwide depression. We don't know, but we'll assume the average. What we can show is what happens to valuation at the end of 10 years. We know what valuation is today. It's at a value of around 31. So what happens? We can project out future possibilities, okay? First one, What if valuation multiples contract over 10 years back to the long-term average of 17? That means you have a big valuation headwind, multiple contraction of about 6% per year, which means Bogle's equation gives you US stocks returning 1% for the next decade. Depressing. Good news is inflation's tame. So remember, inflation's tame, people will pay more. So let's say valuation multiples go back to 21. That's not so bad. You're going to do about 3% per year. Okay, that's still depressing. However, we have to assume the possible worst case scenario and best case scenario of things that have happened in the past. Possible worst case scenario, valuation multiples go back down to 10 or 5, in which case valuation headwind of 10 or 16% per year for the next decade, which translates into negative stock returns of 4 to 10% per year. Gross, right? That's awful. If you haven't hit pause and moved on already, there's at least some good news. We can look at the flip side. Let's be positive. Let's say valuation multiples stay where they are. Well, you get to 7% returns. Okay, great. Let's say, who knows, valuation multiples increase. Let's say that people get euphoric about the stock market. Hasn't happened in a long time. Seems like no one cares. We call this the Jay Cutler bull market. But let's say valuation multiples increase to 45, which is the highest we've ever seen in history in the United States in December, January of 1999. Guess what sort of return we get then? 11% per year. Do you notice the problem? Going back to the first episode, going back to the beginning of this episode, what do people expect? People expect 10% returns. The way we get to 10% returns, valuations have to increase to the highest level they've ever been in history. Is that possible? Yes. Is it probable? Probably not. The most likely scenario is about 1 to 3% returns. And if you're listening to this and you're just like, no, Meb's this bearish guy, he's an uber bear, let's channel John Bogle. Before he passed away, RIP John, national treasure. He should get the Presidential Freedom Medal, has done more for investors than anyone in the country in improving their investment outcomes. He forecasted low single-digit returns. He's a very sober person about future expectations. So look, I'm being a little depressing. I'm forecasting US stocks to do about 1 to 3% per year. And channeling Lloyd Christmas, just like in Dumb and Dumber, saying there's a chance. Look, there's a chance. One of our favorite investment shops, Research Affiliates down the road in Orange County, says for US stocks to achieve the historical returns, there's about a 1% chance. I think they've recently updated it to 2%, but it's not a lot. But again, looking at this as a spectrum of future probabilities, the most likely outcome is moderate returns. Could be better, could be worse, but you should set expectations for low single-digit returns. So what's an investor to do? You're forecasting 1 to 3% returns. That's pretty awful. Well, the first piece of advice is, hey, be realistic. Take your medicine. Spend less, save more. That's always good advice. It's hard to tell people. Again, if you're an investor looking to a financial advisor or hedge funds or whatnot, are you going to go with the one that says, hey, I can probably get you 3% returns? No. You're going to go with the one that says, oh, I can get you 10, 15, 20. But is that realistic? Probably not. So what do most people do? All right, we don't live in a world of just US stocks. What about US bonds? The problem with US bonds, as we talked about in the first episode, is bonds are actually really easy to forecast. You got the starting yield. I'm going to round up because I'm an optimist. It doesn't seem like it, but I'm an optimist. I'll say 3% in the US right now, which, by the way, is one of the highest yielding countries in the world. But let's say 3%. That's the return you're going to get over the next decade on a nominal basis. There's like a 90% correlation between starting yield and future 10-year return. We don't know inflation, but in general, let's call it 3% returns. But again, the problem with bonds is not forecasting the return, it's what does inflation do? And we talked about this historically. If inflation is actually higher, 2, 3, 4, 5%, which we don't know, of course, you actually have negative returns. And looking back in history, in the 60s, 70s, 80s, bonds really struggled because of high and increasing inflation. And that's really where your money starts to erode. So what do most people do? They diversify. Investing 101. Don't put all your eggs in one basket. They put some in stocks, some in bonds. John Bogle famously said, I put half my money in stocks, half my money in bonds. That way I spend half my time worrying I have too much in stocks, half the time worrying I have too much in bonds. And he said that tongue in cheek, but it actually makes sense. Diversification helps. As long as you have two assets that are not perfectly correlated, you put the two of them together, you end up with a better product. So a lot of people have the famous 60-40 portfolio, which is 60% in stocks, 40% in bonds. It gives you an outcome that's a little lower return than stocks, but also lower volatility and drawdown. Here's the problem. Let's look at the forecasted 10-year expected returns for stocks and bonds. Remember we said US stocks, I'll be an optimist, let's call it 3%. Not 1, we'll call it 3, okay? US bonds, also 3%. There's no way to mix those two asset classes to get an outcome other than 3%. You can't add the two of them together and get the expected 8% return of every institution in the US or the 10% return most people expect. So what do? The answer for some people is to speculate, to take more risk, invest all their money in cryptocurrency, buy a bunch of cannabis stocks. May work out, may not, who knows? But it's a big challenge when you have lower expected returns, one of the lowest opportunity sets in the past 120 years for future expected returns. That's the bad news. Why don't we get to some of the good news, all right? I want to pause here. I want everyone to think about this question. As you think about your portfolio, be honest, there's no one else watching this. As you think about your portfolio, just the stocks. We're not talking about bonds, not talking about your crypto, not talking about anything else, just the stocks. For my American investors, how much of your portfolio is in the US? Okay? Write down that number, put it in your head. How much do you have invested in US stocks as a percentage of the total? And for all my investors around the world, think about it in terms of your own market. My investors in India, Italy, UK, France, Australia, everywhere, Brazil. Think about it in terms of your own country. All right, you got the number? All right, for US investors, ready? I'm about to pull out my fortune teller hat. Your answer, 80%. Okay, maybe it's 70, but I guarantee you almost everyone says 70 to 80% in US stocks. Why is that a problem right now? Let's look at the global market index. So if you invest in stocks as a percentage of the world, let's go back to the 1970s, okay, when the first indexes were developed that were investable. Market cap investing, do you know what that means? A lot of people say they know what it means, but they really don't. So when you say, okay, let's say you're investing in the largest stocks in the stock market. Think about the S&P 500. And most people will say, yeah. And then I'll say, okay, but what do you mean by largest? And they'll say, well, you know, they're the biggest companies like Apple and Amazon. I said, yes, correct. Biggest by what measure? People say by sales, earnings, revenues. That's wrong. No. The only measure is the stock price times the shares outstanding. And that means market cap, how big the company is based on its stock price. Has no fundamental tether, how many employees it has, does it have earnings or not, does it have any sales? And that's an odd way to build a market, but that's what the market average is. As you look at the global market index of just stocks, you bought every stock in the world. What does that mean? That means you put about half in the United States and then a sprinkling in all sorts of other countries around the world. Japan, China, Europe, emerging markets. But think about that for a second. You're putting half your money in one stock market. Why is that problematic? While market cap weighting is the market, it is the average, and it's done spectacular over time, I often tell people it's not optimal. If you're an alien that came down to Earth and you said, how do people invest? And you told them based on stock price times shares outstanding, they would say, that is a curious way to do this. It has no tether to fundamentals, towards value, towards earnings, any of that other stuff. But let's look back in history, all right? So if you go back to, say, the 1970s and look at the S&P 500, great returns over this period, right? You've compounded in 40, 50 years at awesome rates. However, what if you invested in the largest stock in the stock market at the time it was the biggest? Right now, I think that's Apple, maybe Amazon, but over time it's been IBM, GE, all sorts of companies that everyone's familiar with, Microsoft. Would that be a good investing strategy? It is a horrible investing strategy. If you invest in the biggest stock in the stock market at the time it's the biggest, it underperforms the broad market by about 3 percentage points per year. Additional research has shown that research affiliates, amongst others, have shown that this applies to other sectors. If you invest in the largest stock in a sector, think healthcare, technology, it underperforms the market for the next decade. And in some countries, it's even bigger amount. So this applies to almost everywhere. And you say, why is that? It actually makes a lot of sense. Think about the forces of creative destruction. That's just capitalism. By the time Apple gets to be the world's first trillion-dollar company, you better bet there's a company in Asia that says, I would love to make billions of dollars too. So this competition, this creative destruction is wonderful for how the world develops new products and technologies, but you don't necessarily want to be investing in these big stocks because by the time they get to be the biggest, they're often expensive. If you look at Apple right now, its stock market capitalization at $1 trillion is larger than 3 entire sectors. And a fun tidbit, if you look back in time, once we hit this milestone of $1 trillion, let's look back at some of the stocks that hit other milestones. The world's first $10 million stock. Anybody? Dutch East India Company. The world's first $100 million company. The Mississippi Company. What was the world's first billion-dollar company? AT&T. 10 billion? GM. What was the world's first $100 billion company? It was Japanese, Nippon Telegraph and Telephone, and the world's first trillion-dollar company was Apple. If it was private, it would maybe Saudi Aramco, but in general, Apple was the first one. But look back, how many of those companies and stocks still exist? You don't see the Dutch East India Company still trading, and a lot of these have fallen by the wayside. AT&T, GM, Mississippi Company. That's what happens. That's the renewal of creative destruction and capitalism. So if we talk about market cap weighting being decidedly suboptimal, what's the solution? Our favorite expression is anything but market cap weighting. I actually don't think it matters. You could weight portfolios by whether the CEO eats hamburgers, cheeseburgers, or veggie burgers. And any of those should outperform the broad market cap weighting. The reason being is that market cap weighting often tilts you towards expensive companies. So if you look at this globally, we were one of the first people to do this, if not the first, I think we were. Other people do it now, but we created CAPE ratios, 10-year price to earnings ratios for every country in the world. So some countries you can take back to 1900. Some countries you can only take back to the 1990s because their stock markets haven't been around that long. But in general, we have a fairly decent history of valuations. What do we find? Well, in general, we find that US stock markets move together. Makes sense, right? They're all stocks. But at times, there's pretty high correlation. Sometimes there isn't. But you also find that there's pretty wide valuation spread. There's times when some countries are super expensive and in bubbles, and there's time when some aren't. And there's some times where there's countries that are super cheap. So let's rewind back to 1980. There's been a couple distinct periods where you've seen outsized valuations. You've seen this in the mid-2000s. If we were recording this or you go back in time to the mid-2000s, everyone on the planet in the investing world was talking about the BRICS. That stood for Brazil, Russia, India, and China. Everyone had wanted emerging markets. They were the growing darlings of the world. Both China and India at one point were trading in price to earnings ratios in the 40s and 60s. That's higher than the US was in the internet bubble. Then we go back to the US bubble, but the granddaddy of them all. The biggest bubble we've ever seen in equity markets was Japan in the 1980s. Long-term students of history will remember this. Again, the gray hairs, the no hairs, remember Japan. Every business we cover, every book was about the Japanese economic miracle. It was about the business model. Copy the Japanese business model. Japanese stocks were soaring. You got to see a lot of bubble behavior. Japanese companies were buying up land and properties all over the US. Trophy properties like the Rockefeller Center, like golf courses in California. There was at one point when people claimed that the land under the Imperial Palace was worth more than all the real estate in California. In Japan, in the 80s, they got to a price to earnings ratio of 100. Well, guess what? Over the next 30 years, Japanese stocks have returned 0. This isn't some backwater economy. This isn't the 20th or 30th smallest economy in the world. This is the number 2 economy. Right now, it's now 3rd after China. At the time, it was the biggest stock market in the world. I was just over in Japan, having happy hour with some friends. Buy and hold is not even an investing concept there. Why would anyone buy and hold stocks if they go nowhere for 30 years? So, is valuation helpful globally like it is in the US? It turns out it is. The less you pay for something, again, not rocket science, the higher your future returns are. Stair-stepping down to if you pay for something that's really expensive, chances are you're not going to have great returns. And if you look at the CAPE ratio, again, the CAPE haters out there, there's so many. My friend Rob Arnott famously says, when you bring up CAPE ratio and it's expensive, critics abound. I don't care if you use CAPE ratio. We track in a whole assortment of long-term valuation metrics. We track 10-year dividends, 10-year cash flows. They all tend to say the same thing at times. But we often say there's a high correlation between price-earnings ratio and valuation metrics and drawdowns. Again, we talked about drawdowns in the first episode, how far you're down on your investment. And it turns out when countries or securities or sectors are trading at all-time highs, so 0% drawdowns, they tend to be more expensive than stock markets that are down 50, 70, 90%. It turns out valuation metrics, like price-to-earnings ratio, have a high correlation simply with drawdowns. The P in the price to earnings is often the more volatile component. So the more something goes down, not rocket science, the cheaper it gets. So often when you have really cheap countries, it's simply because they're down 50, 70, 90%. One of the biggest takeaways from this talk should be that one of the biggest forces in investing is mean reversion. Just when you think you're hot stuff, you're compounding your investment account at 20% per year, you're checking your statements every day, you're thinking about vacations, a second home, think about how brilliant you were to buy that IPO, all right? Markets have a way of humbling you. And on the flip side, when you're extremely despondent, you're depressed, you're not opening your statements, you're cursing your neighbor for recommending that idiotic stock, chances are there's a good chance markets will rebound. They have a way of happening over and over again. So we looked at history in this global data set when markets were trading at bubble territory, meaning at CAPE ratios 45 and above, true nosebleed. And in the future, 1, 3, 5-year returns were all negative. And that to me is a true bubble. I don't think the US at 30 is a bubble. It just means it's going to have lower returns. But when you get to the 40 and above, that's true bubble territory where no sane person would say future stock returns are likely to be positive. Again, the biggest complaint about buy and hold investing in market cap weighting is it doesn't check the common sense box to me. In the 1980s, is it common sense to pay 100 times earnings for Japanese stocks? No. But let's look at the flip side. When there's true blood on the streets, hopefully that's not literal, but figurative. When there's blood on the streets, when no one wants a stock market, when they're trading at CAPE ratios below 7, and PIMCO and others have replicated this research, it turns out future stock returns are awesome. We're talking about double digits, often above 20% per year for the next 1, 3, 5 years. Here's the hard part. And all of investing is always hard, but this is particularly hard. And this is why value investing is often really challenging for people. So as you look around the world, the US is trading at a CAPE ratio slightly above 30. One of the most expensive stock markets in the world of the 45 markets we track, okay? Foreign developed, the good news is it's down around 20. That's pretty normal and pretty average. And most of the time, most countries, most stock markets spend most of the time being average. They may be a little expensive, a little cheap, but on average, they're totally normal. Foreign emerging, down around 15. Downright cheap, and depending on the index, could be even lower. If you pick the cheapest of the cheap, the detritus at the bottom of the ocean, the countries that are trading at the lowest quartile, so the lowest 25% of countries, so the cheapest 12 out of 45, you get a PE ratio, CAPE ratio of down around 12. And that's downright cheap. Here's the further problem. If you look at the countries that comprise the cheapest, all right, I hope you didn't just eat lunch because you're going to get nauseous here. Russia, Brazil, Greece, Spain, we'll throw in a little Turkey just to round it out. It is the who's who of worst stock markets, of worst economies, of worst geopolitical news. We're talking the last 5 years, some of these countries have had impeachments, they've invaded other countries. One of them even went through a global depression. But historically, you've been rewarded for investing in the cheapest stocks in the cheapest stock markets. There's a couple takeaways from this idea, okay? One is you never want to just go buy one country, all right? It's too risky. These stock markets can go up and down 50% in any given year. A famous investing joke is, what do you call an investment that's down 90%? It was an investment that was down 80% and went down 50% more. So even if you buy something that's down a lot, it's not guaranteed to go up. But in general, countries don't go away. With the exception of Russia in 1917, China in the 1940s, in general, stock markets are robust over time. So what you want to do is you want to buy a basket of these countries because you never know which one's going to outperform over time. So we recommend about a dozen of these countries. It doesn't matter how often you rebalance them. If you do it any more than once a year, it actually hurts. So you can buy a basket of these countries, put them away, check back in again in 1 year, 3, 5 years. Many of these countries, in looking at the actual valuations, the cheapest country in the world right now is Russia. And that's part of the challenge and part of the reason it's so hard. Investing in cheap stuff means, by definition, you're investing in negative news flow. Think back to 2009 in the US, where a lot of people screaming to invest in stocks. No, why? Because everyone's unemployed. No one had a job. I've traveled the world since publishing this book. Again, we've talked about this, Global Value. It's for free online at CambryInvestments.com. So about a summer or two ago, I was so excited. I was traveling to Eastern Europe, and I said, finally, I get to talk to some local investors and tell them their stock market's cheap. They're going to shower me with roses and beers and hugs and everything else. And I gave this speech, and I said, you guys, the good news, your stock market's cheap. It's going to compound at double digits for the next 10 years. Crickets. The room was totally silent. And this is obvious in retrospect, but I scratched my head. I was chatting with a few guys later. I said, why wasn't this more well received? They said, Meb, everyone knows this is a great buying opportunity. Nobody has any money. Remember, our stock market's down 60, 80% already. Everyone's already lost all their money. Youth unemployment's 50% in Spain. We already know the answer to this, but it's too late. Nobody has any money. So the challenge, as the big takeaways from this, is you buy a basket of the cheap stuff, but equally as important is you avoid the really expensive, the dumb mistakes. The good news is, around the world, there's not a lot of expensive countries. The US is one of the most expensive. We can throw in Denmark and some others, but in general, the world's pretty cheap. And the challenge of this, there's a famous saying my buddy Mark Yusko says. He says, investing is the only business when things go on sale, everyone runs out of the store. So trying to buy some of these countries and companies that are cheap is really hard. I guarantee you right now, some of you are listening and say, no, Meb, the US deserves this valuation premium for all host of reasons. Stable geopolitical situation, rule of law, et cetera, et cetera. My least favorite, by the way, is they say that US stocks get 40% of their revenue from abroad, therefore you're already diversified. So my response to that is always, you don't think foreign companies get exposure to the US and other countries? And in fact, in many countries, it's more. In Ireland, it's like 60 or 70% of revenues come from abroad. So we live in this borderless world. You could have a company in Mexico that gets all of its revenue from Sweden. Is that a Mexican company? Is it a Swedish company? And so as borders become less significant, you need to be agnostic about countries and sectors and location. And if that's the case, you should actually think about going anywhere for value. Let me give you a good example. In the last 70 years, the US stock market has been a darling. It's outperformed foreign stock markets by 1% every year for the last 70 years. That's an enormous amount compounded over 70 years. That means if you invested $10,000, fast forward 70 years, in the US that would have compounded to 14 million. And only 8 million in foreign stocks. Guess how much of that outperformance has come since 2009? All of it. Let that sink in for a second. For the past 70 years, all of the US stock outperformance versus foreign stocks has come in the last 10 years. The US market has destroyed everyone else over the last 10 years. Historically, investing in US stocks versus foreign stocks is a coin flip. 50-50, which one outperforms. And you've also had this major expansion of the US as one of the biggest economies in the world. Remember, back in 1900, 15% of the global market. Now it's well over half. Do you expect that to continue and the US market just gobble up everyone and become 60, 70, 80%? It's unlikely. And on top of that, if you look back in history, the US isn't always one of the most expensive markets. There's been plenty of times it's been cheap. For the entire 80s, there was the famous Business Week cover, the death of equities at the literal bottom of the stock market, generational buying opportunity in the early 80s. And remember, you had that massive Japanese bubble, buying opportunity of a lifetime to buy US stocks and to avoid Japanese ones. Fast forward today, we wrote a recent article called The Biggest Valuation Spread in 40 Years, meaning US stocks versus the rest of the world, a huge gap. Our friends at GMO, Jeremy Grantham's shop, recently put out an article, and they use emerging markets specifically, and they said emerging markets is the biggest opportunity set spread to the rest of the world in their entire history. I would go a step further and say if you buy the cheapest markets, the cheapest of the cheap, it's actually even better than emerging. You'll get a bunch of emerging in there, but you'll get a handful of developed markets too at this huge spread versus the US. And if you invest in the cheapest markets, the who's who of the worst economies, stock markets around the world, trading at a P ratio of around 11, that's even bigger spread versus the US and the rest of the world, and I think a generational buying opportunity. Again, most of you look around and invest most of your money in your own market. Americans, don't feel so bad. You put 80% in your own market, it happens everywhere. Happens in Japan, happens in UK, happens in Brazil. Everyone puts too much of their money in their own market. It even happens in sectors. Our friends in the West Coast in the US have an overexposure to technology. Our friends in Texas, guess what? Energy. Our friends in the Midwest, upper Midwest, industrials, everyone has this home country bias because you have this level of comfort, this false sense of security that you understand your own market. But I guarantee you, you ask anyone who put 80 or 90% of their investable assets in Brazil, Russia, Greece over the past 10 years, they would tell you it's a horrible idea. Ask anyone who's done that with energy stocks. Ask anyone who's done that in US stocks. Or even worse, putting it all in one stock of one company or retirement plan. Go ask any Enron employee of the past 20 years, they don't exist anymore, how good of an idea that was. It's a horrible idea. We always have people tell me, they say, no, Meb, CAPE ratio. If you've been using CAPE ratio, you would have sold US stocks in 1993, never to invest again. And I would have said, that's right, and that's a good thing. You would have missed 900+% in gains by getting out of US stocks in 1993, but that's a good thing. They pull their hair out, they gnash their teeth, and say, you're crazy. How is that a good thing? You missed amazing run in US stocks, one of the best in history. And I tell them it's because the way most people use valuation is the wrong way. They want a magic crystal ball, binary suggestion that's going to tell you to either get out or get in. And that's not the way to do it. We don't live in a world of just one asset. If you instead have sat in long-term bonds instead of US stocks, you would have had about the same return. Instead of 9% in US stocks, you would have had 7.5% in bonds. And the volatility would have been lower and drawdown would have been smaller. But again, it's not just US stocks and bonds is the question. We live in a world of opportunity. If instead in 1993, when US stocks first got expensive, you said, all right, I'm just going to be agnostic. I'm going to invest in markets where they're cheapest anywhere there may be. Maybe the US, it may not be. You would have ended up with vastly higher returns. You would have stomped any possible market in the US, equity or bonds over that period by being country agnostic. So investors often will ask me, say, okay, Meb, how do I find these CAPE ratios? Let me give you a handful of resources. We publish them on the Idea Farm, but there's a lot of free resources out there. Research Affiliates has a great asset allocation tool, German fund Star Capital, Global Financial Data, French Fama, Damodaran, Ned Davis, all wonderful resources for valuation on countries as well as sectors over time and historically. So as we wind down this talk, the biggest takeaway is why this matters right now, particularly for global and US investors. Remember, US as a percentage of world market cap is half. That means you're putting half your money in one of the most expensive stock markets in the world. It's not terrible, it's not awful. It's at a P ratio of around 30, but you're putting half your money in the most expensive stock market in the world. If you're American, you're putting 80% into your own market, one of the most expensive stock markets in the world. I encourage you to call our friends in Japan and say, hey, was that a bright idea to put the vast majority of your money in the most expensive stock market at the time, back in the 1980s? And they would tell you, you're crazy. So the takeaway here, so many of you put 80% in US stocks, and God bless you. You've had amazing returns over the past decade. Well done. A lot of people are not aware that they're making a very active, concentrated bet. So look, if you're fine with 80% in US stocks, fine on you. But realize you're making a huge bet relative to the global index. And we often tell people that should be the starting point. If you're a global index or Vanguard, by the way, it says you should put 40% in foreign stocks. 50% in the US is the starting point. And if you're a value investor, you could actually tilt further away. In some cases, you could put 66, 70, 80% of your assets in economies and stock markets outside the US. That's very uncomfortable. But if you're trying to outperform, it pays to be weird, different, and concentrated. The hard part is you're going to look different than the rest of the world. So quick summary. We reviewed that the US opportunity set is pretty poor. US stocks, expect them to do about 3%. US bonds, about the same. Not a great time to be invested in US assets. So first piece of advice, go global. Look beyond our shores, become country agnostic. Rest of the world is at reasonable valuations to downright cheap to extremely cheap. So tilting away, you don't have to go all in on Brazil and Russia, but just tilting or over rebalancing towards valuations that are cheap makes a lot of sense. In future episodes, we'll talk about asset allocation, how to put this all together, and implementation. Thanks for watching, friends, and good investing.